I want to bring in Edward Meir. He's the senior commodity analyst at MF Global. MF Global has been cautious on the commodities markets for quite some time, even before Goldman Sachs raised the issue on that. Goldman, though, says that we're likely to see some sort of rebound in commodities. And Edward, I mean, you feel the same way?
Well, I think kind of extrapolating to 2012 is very dicey at this point. I think sort of the best case scenario is for what we could say about the second half of the year, and that is we think that commodities will likely settle into a trading range, kind of a sideways motion, not spiking higher or lower necessarily, but just kind of flattening out, because the growth outlook basically for the second half of the year will be much more restrained than what we've seen over the last 6 months.
Ed, it's John Erlichman. Let's get a little more specific. Trading range is something that I think a lot of people don't understand, and a lot of people really got burned over the last week with that huge sell-off. So what does it mean? You're saying if the average investor got into the market this year, got into commodities this year, all of a sudden got wiped by that big hit, you're saying they should be buying commodities, they should be selling, they should be doing nothing? What?
Well, I think, first of all, on this current move, I think we have a little bit lower to go. So oil can conceivably get to around $90. At that point, I think it's probably an attractive entry point, given what's happening in the Middle East. But we certainly don't look at, we're not looking at prices in excess of 120 or anything like that. So that should be kind of your guidepost, so to speak.
It's Dominic here. One of the things that we talk about often is in this huge move here was how much the margin requirement hiking for silver really kind of plummeted that metal down there. How much do commodities kind of respond to, say, financial dynamics as opposed to simple supply and demand? A lot of analysts out there are saying it's no longer a question of supply and demand. It's just about what's happening strictly in those futures financial markets.
Certainly, the margins are a big factor when you consider how little you have to put up to buy some of these commodities. Every time they increase the margin, it obviously will wean out some of the incremental longs, the weaker longs. They may have to bail out. Secondly, you may have a situation where if you're a commodity fund, you have an array of commodities, and if silver is flushing out and going against you, you may have to liquidate positions in some of the other commodities you're holding in order to raise cash. So that certainly is a factor.
But Ed, if you're looking for direction, isn't the biggest factor what China is going to do?
Sure, absolutely. And that was our main reason for being cautious on the group as a whole going into the second half. People are forgetting that the Chinese keep raising their rates. They've raised their rates, I think, about 6 or 7 times in the last 6 months. They've raised reserve requirements. So that's inevitably going to slow their economy down, which means imports for metals, for oil, for what have you, are going to be less on a year-to-year comparison basis than they were in the first half of the year.